Yeah, so you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin.
Popular technical analyst and president of InTheMoneyStocks.com, Gareth Soloway, is doubling up on his previous predictions for risk assets amid the Federal Reserve's unwavering hawkish stance. In a recent interview with Kitco, Soloway predicts that the U.S. stocks and crypto markets will erase all gains since 2020 by the end of the year. He adds that though the markets expected last week's 0.75 percentage points rate increase, investors were not expecting Fed officials to remain so hawkish. As a result, the technical analyst believes that last week's massive price declines will continue until Bitcoin, Ether, and the stock markets hit new yearly lows. He adds that traders and investors are desperately looking forward to a Fed pivot, but that won't come because inflation has become sticky. Like many other market experts, Soloway is worried that the recession will continue to worsen with no recourse from the Federal Reserve because inflation will remain above its 2% target. Meanwhile, the dollar continues to strengthen against key foreign currencies, indicating more bearishness for the markets, especially for risk assets. We will now take you to Gareth Soloway's interview. Please watch, share, and like this video. Also, ensure you drop your comments and observations in the comments section. Subscribe if you are yet to do so, and turn on the notification bell to get notified when we post new videos. Thanks, and enjoy the video.
Well, I mean, the narrative that has changed is the Fed has continued to be so hawkish. I mean, much more hawkish than even I thought they would be. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385. So 3,385 on the S&P 500. 5 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now, think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0. And now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things is like, it's one thing to say, oh, if we go into recession, the Fed can save the day by coming in and, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a long-term bear market. You are seeing inflationary pressures kind of ease a little bit, but what's not easing right now, and I think this is why the Fed is being so hard-nosed, is that the labor market is still demanding higher wages. And wages, again, and this is something that I've talked about before, is that when a company has to double the salary for an employee, they can't just double the price they're charging for a widget, right? So what they do is they'll raise the widget by 10% this year, next year 10%, 10%, 10%, and they make up for it over time, getting their margins back in line. And I think that's the key, is why it's going to be remaining sticky on the inflation side. The input costs are coming down; those will come down, but you have that wage issue that is still sticky.
Inflation becomes sticky when there is a combination of stubbornly high inflation and growth stagnation or decline. It's often associated with cost push factors that cause a rise in prices, leading to reduced spending and GDP decline. As Soloway explained, wages are falling far short of rising prices, and the labor force is pushing for higher wages. This would put more strain on the economy as companies look for a way to make a profit without driving away consumers. As Real Vision CEO Raoul Pal succinctly puts it in his interviews, something has got to give. The Fed might soon have to start printing more money to return confidence in the markets and save the economy, or sit back and watch as everything hits rock bottom. Let's get back to Gareth Soloway's interview as he discusses his outlook for Ether and Bitcoin.
I think the key here is to just understand what type of market we're in. When you're in a bear market, it takes a lot to get price to go up because people are scared, right? So, if you're in a bull market, you could have the tiniest bit of news and price will rip up. It could even be news that's not relevant. And we've seen stocks like GameStop, AMC. I mean, all these things just go to the moon. But the problem is we're in a bear market, and in a bear market, people really need value. They need to know that something is immediately changing, and the merge isn't doing that, right? Yes, long term, it's probably fantastic for Ethereum, but in the near term, what is everyone focusing on? The Federal Reserve, interest rates, the US dollar, the economy, and all of those things are just crushing risk assets right now. So it was kind of a no-brainer to me that you saw a kind of an early front-loaded run up a few months ago, and then it just kind of came right back in. This first target is going to be back. So we are at a little bit of support per the chart. So you can see we bounced off these pivots right here. All right. And that's going to be a short-term little bounce. And then eventually we're heading back to basically just below 1,000, the double bottom. And then if I'm right that Bitcoin is headed to 12 to 13,000 and maybe even below, then I got to think that Ethereum could easily be headed down to, 700, 600 area.
And that's going to coincide with the 3,700 S&P?
Yeah, so I think probably the 900 to 1,000 is the 3,700, and then the next leg lower in the S&P takes you down to that 600 to 700 level on Ethereum. Yeah, so you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin. So to be fair, I know enough from my career to know that I don't pick exact lows. Yeah. And so basically in the teens, I'll be already starting to accumulate all the way down below. So basically, you see 16,000, I'll pick up a tiny bit, 13, I'll pick up a little bit more, 10, all the way down there. And the idea there is I do believe that eventually Bitcoin's 100,000, 500,000. And so I'm not going to try to pick a bottom and miss it. Instead, I'll just dollar cost average in this lower range to build that core position.
Though Bitcoin and Ether remain far above Gareth Soloway's price predictions, both crypto assets are still showing a lot of stress from the macro environment. Since the Fed announced the last interest rate hike, the world's leading crypto asset has spent more and more time below $19,000. As of press time, it is trading at $18,733, a 1.51% decrease in the last 24 hours. Ether has slipped further to $1,295, according to data from CoinMarketCap, a 2.40% decline in the last 24 hours. Of the top 10 cryptocurrencies, only Ripple, Dogecoin, Binance, and Solana are the only assets posting decent gains over the past week. But we must continue to look at the long-term prospects of these assets. In a recent interview with CNBC, the founder and CEO of Pantera Capital, Dan Morehead, predicts that billions of people will be using cryptocurrencies in 4 to 5 years. He adds that several financial sectors might be distressed in the coming years, but the digital asset industry will not be among them because of its strong fundamentals. Here's a short clip from the interview.
Yeah, I think the important thing to keep in mind here is crypto is such a disruptive thing that's going to change so many aspects of our lives over the next couple decades. It's in a secular bull market, and it does occasionally get caught up in these cyclical downdrafts of risk assets. But I can easily see a world a few years from now where risk assets themselves might be still struggling, but blockchain's back to all-time highs and doing its own thing based on its own fundamentals. And that story is hundreds of millions of people use blockchain today. I think in 4 or 5 years, it's going to be literally billions of people. And the way to value things is supply and demand. If you have a billion people that want to buy a fixed number of coins, the price probably goes up.
Though Gareth Soloway might be bearish in the short term, his long-term prediction for crypto assets fits perfectly with Morehead's forecasts of massive adoptions for Bitcoin, Ether, and other crypto assets. What are your short and long-term predictions for Bitcoin, Ether, and any other crypto assets you're interested in? Please drop your replies in the comments section below. Also, be sure you let us know your thoughts on Soloway and Morehead's forecasts for the industry. We love bringing you important market updates from the industry's most brilliant minds, but we can't keep doing that without your support. So please like this video, subscribe to the channel, and drop your comments below. Everything helps with the YouTube algorithm so we can reach more people. Thanks for the continued support, and thanks for watching.